Have you ever really thought about how to make your money work for you? I mean, not just sitting in an account, but actively growing into something more over time. It's a huge question, and the answer, well, it often comes down to one of the most powerful ideas in finance, compounding. Let's dive into how it all works.
So first things first, let's talk about a problem that a lot of people face sometimes without even knowing it. It's the hidden cost of doing nothing, the quiet danger of letting your cash just sit there.
I want you to really think about this for a second. That money you've worked so hard for, the savings you've tucked away in a bank account, is it actually safe? Or could it be, silently losing its power right now? Here's the thing. There's this silent thief called inflation that's always at work. Over time, it just eats away at the purchasing power of your money. What that means is, the 1,000 rupees you have in your wallet today, well, it's not going to buy you the same amount of stuff a year from now. So, any cash that isn't growing is, effectively, shrinking.
Okay, so if letting cash sit idle is the problem, what's a potential solution? This brings us to a really powerful alternative for building wealth over the long haul, the stock market.
At its core, the stock market is a pretty fascinating place. On one side, you have companies, right? They need money, capital, to grow, to innovate, to build new things. And on the other side, you have people like us, investors, who are looking for a place to put our money so it can grow. The stock market is basically the bridge that connects those two groups.
So what are people actually buying and selling? Stocks, which are also called shares. And buying a stock is more than just a transaction. It means you're buying a tiny piece of that company. Whether it's a huge tech company or your favorite brand of snacks, you literally become a part owner.
Now, to really see the difference this can make, let's look at a tale of two different approaches over 20 years. This is where the magic, or really the simple math, of compounding comes to life.
All right, let's run a little thought experiment. Imagine that for the next 2 decades, after you pay all your bills, you diligently save all your extra cash. Year in, year out, you just put it aside and let it pile up.
So, after 20 years of just collecting that cash, you'd end up with about 1.7 crore rupees. Now, don't get me wrong, that is a serious amount of money. But remember, that's just the total of what you put in. And with 20 years of inflation chipping away at it, what it can actually buy would be a lot less.
But here's where the story takes a huge turn. What if, instead of just letting that money sit there, you had invested it into the market every single year? How different would things look after those same 20 years?
Well, the final number would be a whopping 4.26 crore rupees. I mean, just look at that. This one comparison shows you everything you need to know about the power of compounding. The final value isn't just the money you saved, it's all the growth that money generated for you along the way.
Let's put a number on that difference. By investing, your final pile of money is 2.4 times bigger. That's the difference between your money taking a 20-year nap and your money being put to work, compounding, and building real wealth for you.
Okay, so let's zoom out a bit. How does investing in stocks, or what we call equities, really stack up against the other common options you have for your money?
Before we dive into the numbers, we need to understand a quick term, CAGR. It stands for Compounded Annual Growth Rate. All it really is a way to find the average yearly growth of an investment over time. It just smooths out the bumps and lets us compare different things apples to apples. Now, take a look at this chart. This is based on 20 years of history in the Indian market. On average, equities have delivered an annual growth rate of about 15%. Now compare that. Fixed income products, like FDs, around 9%, and bullion, or gold, around 8%. The data is pretty clear. Over the long haul, equities have historically given the best returns. But of course, it's not all just about chasing high returns. We have to talk about the other side of the coin, and that is risk. It's super important to have a balanced view of this.
And it's totally natural to have questions, right? Things like, what happens when the market goes down? Or what if I lose my money? These are valid, important questions that every smart investor should be asking.
So let's be really upfront about the risks. First, there's market volatility. Stock prices go up and down, sometimes daily. That's just how it works. Second, there's no capital guarantee. Unlike a fixed deposit, your returns aren't promised. And third, yep, value destruction is possible. If you invest in the wrong companies, you can lose money. And this is exactly why the mindset has to be about long-term patience, to ride out all those short-term swings.
And that, right there, brings us to the real moral of the story today. Building real wealth through investing is not a get-rich-quick plan. It's a patient journey that takes time.
I think this quote just nails it perfectly. To get those truly meaningful returns, the kind that can actually change your financial life, you have to depend on compounding. And the key thing about compounding is it needs time to work its magic.
So, I'll just leave you with this one final thought. 20 years from now, what story will your money tell? Will it be a story about sitting on the sidelines? Or will it be a story about being put to work to build a better future? Ultimately, that choice is yours.